So this is still chapter 1, part B, and we ended up here, we're at the beginning of really your outline, and so let's continue on. What long-term investments should the firm take on? So we're talking about, what do corporate people do, corporate finance people do? They're looking at what long-term investments should the firm take on, where will they get the long-term financing? Financing means how do we supply funds to a business, whether it be through stock or bonds or loans. The main person in this is the CFO, or the Chief Financial Officer. And then typically underneath that person we would have a treasurer or a controller, and a lot of times these are kind of more accounting type people, but they can also be, and this can also be an accountant up here. Some of the decisions we have to make. So we have this word capital budgeting. So I know you're wanting to fill in these blanks, so let's go ahead and fill this in. What long-term investments should we take on? How do we pay for our assets? Should we use debt or equity? And how do we manage the day-to-day finances of the firm? So those are your blanks. Once again, those are kind of the important words, important terms I want you to think about when going through this. Capital basically means kind of like money. So how are we budgeting our money? And capital budgeting is a whole chapter, whole kind of section later on in the semester. Capital structure refers to really our balance sheet. When you look at the balance sheet, you have assets on the one side, and then we have debt, or most of you refer to them as liabilities. Finance, we talk about them more being about debt, same thing, and equity. So when we talk about structure, is how much debt kind of versus equity that we have. Right? So it says, how do we pay for our assets? Because these two items over here are what we use to buy our assets. And working capital, so it means like we're using them every kind of day. Short term is our day-to-day finances. So how are we buying our inventory and things like that? So if you haven't had business law, you may not have heard of all these terms. You probably just have heard of them kind of in general. I know you've all heard of corporations. So these are the three major forms that we have in the United States, and these are three general categories, and there are subcategories under each one of these. And you're going to get into these a lot more in business law class. So I'm just going to kind of touch on them here for the moment. So in your blanks there on your page, you would have sole proprietorship, partnership, and corporation. So those are your three blanks there. And then you can see underneath partnership, we have kind of two types, general limited, and under corporation, we have an S Corp and a limited liability corp. And once again, I'm not going to go into depth on these, but this is probably the most common way that business is set up today. So let's go into a little bit more in depth here. So a sole proprietorship means we only have one person. And I have all of these advantages and disadvantages. You do not need to write these down. You do not necessarily need to memorize them because I just want you to focus on a couple things. So you can read these advantages and whatever. What I do want you to write down is this term right here, unlimited liability. Unlimited liability. So unlimited liability means that if something were to happen to the business, and let's say you own a restaurant, somebody gets sick and they sue the restaurant, that not only can they go after the assets of the restaurant, but they can go after the owner, the sole proprietor. So your liability is unlimited, meaning going beyond your business. So that's a very scary kind of situation to be in. Now you can protect yourself by getting insurance, about liability insurance and so on. But anyway, that's kind of one of the biggest distinguishers between this and a corporation. So a partnership is simply two or more owners. Two or more owners. It's just a little bit easier to raise money because you have more people. You're going to be taxed kind of the same way as you would as a sole proprietor. And notice, you can write this down again, unlimited liability. So same thing. Other than if you look on your page there, it says general and limited. You could be a limited partner, okay? Which means you wouldn't have that part. Okay? Limited partnerships means you put in a certain amount of money, $1,000, and if it goes bankrupt or people sue it, all you're liable for is $1,000. Okay? So really, when I talk about unlimited liability, I'm referring to the general partnership. Okay? So I've been in partnerships before. One thing to think about, because I know some of you are going to be going into business and you might go in with another person, it can be very stressful. Be a lot of strain on the relationships because one person, so you have to say this person right here, she's working more or less than the other two, and they're own it by thirds, and so she's feeling she should get paid more. But so you just need to really spell out what everybody's role is in the business and have it written down before you get into business. Save you a lot of stuff here. So corporation is the last one. Big advantage here is, notice this term, limited liability. So it just means that if the company is sued, they can't go against the president and take his or her assets. Okay. Another interesting thing here, it says unlimited life. So it's an entity unto itself, whereas a partnership or sole proprietor, if they die, then kind of the business is done. Corporation can keep going because the shareholders own the firm. And they can, and it's easier to raise money. Why? Because they can sell stock. Okay? So corporations have stock. So you and I can both be part owners of Apple or Tesla. We can go out and buy a share, and very small ownership, but we can be one. Okay? So write down limited liability. And then over here on disadvantages, write down, this is a big one, double taxation. Double taxation means that if you think about a corporation, XYZ here, they have sales, whatever, let's say $100, and they come down, they have profit of $50, and they have tax of 10%, they pay $5 in taxes. So the corporation is now paid income tax to the government of $5. You have earnings after tax of $45. What happens to that money? Often it goes to the shareholders in the form of dividends. So let's just say, make it really simple, you're the only shareholder and you receive the $45 in dividends. What happens now? You have to pay tax to the IRS because you just received dividends. You are the sole owner of this business and you paid corporate income tax there, and then you paid personal tax there. So you have paid taxes twice. That's what we call double taxation. So you can kind of get around this if you're a smaller business by forming an LLC, limited liability. Notice this term, limited liability company. And it allows you to be taxed like a individual sole proprietorship partnership, but also keep the limited liability of a corporation. So that's why I said it's very, very popular these days. All right, so all of these terms I've mentioned are pretty common across the world, but there are other types of corporations internationally, so it's not all about the ones I just mentioned. Excuse me. You can see kind of here is the translation of the types of companies: public limited company, joint stock company. So there are other types around the world. Just wanted to mention it. Okay, here's a trivia question for you. Goal of financial management should be what? What should be the goal of a corporation? Maximize profit, minimize costs, maximize market share, maximize the value of the company's stock. Okay, so real quick, put it on pause, and I want you to just think about it. Which one is it? Okay, so it's pretty easy to say, well, we want to maximize profit. Well, if you think about it, both of these, number 1 and 2, are really almost go hand in hand, because minimize cost means your profits would go up. But it doesn't really talk about sales, so maximize profit is a pretty good answer. And it's almost the number 1 answer. Maximize market share, well, what does market share mean? It just means that here you have a pie, and every business in that pie, in that industry, has a piece of that. And so if you maximize it, so let's say this is your share right now, and then you take kind of take this one over, you've just gained market share. It means you have more sales. It doesn't necessarily mean you're making more money, because you can gain market share, have more sales. You can be a car dealer selling cars below cost and your sales are way up, but you're not making any money. So just because you got market share doesn't necessarily mean you're going to make more money. So the last one is the best answer: maximize the value of the company's stock. Okay? So on your, down there kind of near the bottom, it says the primary financial goal is to maximize the value of the company's stock. Okay? Or you could say company's wealth. Either way. So you could also look at this as the wealth of the company. Sorry, that's kind of hard to read there. Wealth of the company. So we measure the wealth of the company, the financial worth of the company, by looking at the company's stock. So we can easily look on the stock market and say, okay, stock price is X, so many shares, and we can figure that out. Now, why is this the number one answer? Because the value of the stock takes into account the amount of profit that the company is generating. Not only the amount of profit that the company makes right this minute or this year, but the amount of profit that the market thinks it's going to make over the next infinity, really, 5-10 years in particular. Okay, so that's really the best goal of financial management, is to really maximize the value of the company, make it worth more. Okay? So by doing this, does this mean that we should do anything and everything to maximize the owner's wealth? Should we do outsourcing? What is outsourcing? What is outsourcing? You, all as business majors, especially, maybe not the minors, but business majors should know what outsourcing is. So it's when we hire other firms, businesses, to do what we have been doing. Offshoring means that we're sending that outsourced business off the shores of the United States. So it's going to some other country. So outsourcing could be another country, could be also within the United States. What do you think about supportive charities? So when you give money to charities, is that a good or bad thing? Well, and a lot of you say, well, that's a tax write-off. So I just want to make sure you understand what a tax write-off is. That means that if I have sales of $100, and then under expenses, I have charity. So if I give, whatever, $10 to the Red Cross, that means that my profit is therefore $90. Okay? And then I have taxes. Let's just say I have tax of 20%. That would be $18. And therefore my earnings after tax would be $72. Okay? So what was the benefit of giving to charity? Well, let's just assume that I didn't give it. So I have $100, nothing to charity. My profit is $100. My tax would be $20. My earnings after taxes would be $80. So the benefit, okay, the benefit is what? Well, our earnings after taxes is down $8 by giving it to charity. Is that a good thing? Well, you don't want to lower your profit, but you gave the charity $10. The benefit of giving to charity of $10 is that your taxes went down. You saved $2 in taxes. You saved $2 in taxes. You lost $8 in profit. Okay? So you get a little bit of benefit. That's your tax write-off benefit, is that your taxes go down a little bit. Okay? Now, I'm not saying there's anything wrong with giving to charities, but as a shareholder, I'm wanting to get as much money back in dividends as I can. And here, I'm only got 72 versus the $80 pool. As a shareholder, I'm not sure I want to give the charity. Now, some people say, well, if I give the charity, that gives me, you know, like Tom's when they give the shoes away. So that helps increase their sales. Now, that's like a marketing strategy. That's not simply giving for the benefit of giving. You're giving so that you can hopefully make a return on that. So that's kind of in what I would say almost marketing. Okay? What if you created addictive video games, games that, you know, kids can't get off of, causes maybe violence or something, just to make more money? Now that's kind of an ethical question that your corporation would have to decide. So, and of course, you wouldn't do anything illegal to maximize your owner's wealth. So, nothing wrong with doing any of these. I would maybe argue against the last one. Maybe not the best thing you should be doing, but I could see arguments both ways. So the next line there on your page, the goal of the financial manager is to maximize the value of the firm. There's your blank. Maximize the value of the firm. Okay. So right there at the very bottom of your page, what determines a firm's value? What determines a firm's value? Well, that is, let's hold off on that for a minute. So what determines, we talk about what determines the firm's value, we'll get to that in a minute, but how do you measure the firm's value? You could say, well, you could say stock price. Okay? We could look at a company's stock price and say, well, that's what a firm is valued at. Okay? So is stock price maximization the same as profit maximization? So what is the difference? If I make more money, shouldn't my stock price go up? Well, not necessarily. There is a very high correlation. But you could argue that I've seen companies' profit go up, but their stock price go down. Why? Well, profit is generally now, short term, whereas stock price is long term. Long term, meaning they're looking at what's going on right now and what's going on into the foreseeable future and taking that into consideration. Okay? So a company could all of a sudden say, you know what, let's try to maximize their profits next quarter. So they go out and they buy the cheapest raw materials. So their cost of goods goes way down. And when they sell the product, their product has been good quality in the past, but they start selling the product and at the same price they always have, so their profits have done really well. But then eventually, a year or two down the road, the products all start falling apart, and word gets out that this is a pretty inferior product, and so sales go down, profits go down, and that impacts the price of the stock, of course. So if I know right now what the company is doing and I see them going down a bad path, the stock price is going to go down. And, well, we'll talk about that more later. Okay. So that's an example of what I just said. Okay. So what exactly determines a firm's value? Okay. So think about this. How do you determine the value of a stock? So this is like the most important answer for the entire semester, because this is when we talked about, kind of how do we look at the overview. When I gave that other video, you need to watch that other video about kind of the overview of this course. It's only like 10 minutes long. Kind of shows how all of the chapters fit together. This is a key term to understand. So try to answer this question using some time value of money concepts or terminology that you might remember. Okay, so put it on pause for a second. Okay, here we go. And you can turn your page over. A firm's value is here's your blanks, is the present value of all future cash flow. Firm's value is the present value of all future cash flows. And there's the formula, and you'll see that on maybe a couple quizzes throughout the semester. Present value equals a future dollar amount, and we divide it by 1 plus I is the interest rate, and N is whatever year that would be. Okay? So that's present value of just like one cash flow. And so if we have multiple cash flows, which we do with stock, okay, we have all of the, we're going to make $1.50 a share, we're going to make $2 a share, we're going to make $2.70 a share. We're going to bring all those back to today. We're going to add them all up, take the present value by doing all this for each one of those, and that's how we get the value of a stock. So what investors are always trying to do is figure out what's the future going to look like. Okay? So what is the most important time frame for investors? Past, present, or future? Okay? Great, some of you got it right. But think about it this way. If you could have last year's Wall Street Journal, today's Wall Street Journal, or somehow could look at next year's Wall Street Journal, which one would you want? Well, no question you would love to look at in the future. Okay? Yes, it's important to understand the past for the company, but let's say you were looking at Zoom stock 2 years ago. Okay? It wasn't doing that much. Some people were using it for video conferencing, but imagine you could look ahead to see that we're going to have COVID situation and there would be an extreme need for video conferencing. That's what you would have wanted to know. And if you would have known that, you would have bought the stock. So its past might have been fine, and before COVID started, right before COVID started, stock was not doing a whole lot. And then, bam, people saw, hey, this company's going to make a lot of money. So the stock went up like 3 or 4 times its amount in the next few months. So here's just a little kind of trivia question. So I have all of these companies listed by alphabetical order. Which of these do you think, which are the top 2 or in the bottom 1 has the highest and smallest, largest and smallest market capitalization? So market capitalization, if you look there on your page, is number of shares times the market price. So it's really, if you had to buy this company by buying all their stock, which one would you have to come up with the most for? Okay. So I'll give you a second to think about that. Okay, so here's the answer. Apple, and this has changed between Apple and Microsoft. Exxon for the longest time was number 1 up to a number of years, up to about 5 years ago. So Apple is the number 1 answer at the moment, beating Microsoft pretty handily. Tesla is the big newcomer on the field in the last year. Best Buy was kind of at the bottom there. So look at Apple, $2 trillion. Okay, last things we're going to do here. Agency relationships. So totally different, totally new topic here. Okay? So what does an agency relationship mean? Well, the easiest way I think of, I've got this picture of a realtor there, is that you hire someone to act on your behalf. Some of you maybe are famous actors and you have agents. You have agents to go out and get deals for you, or you're a rock star. You have an agent that helps book deals, helps negotiate on your behalf. So we have what we call a principal hires an agent to act on their behalf. So if you're the rock star, you are the principal. Okay, you're the rock star, you are the principal, and you hire an agent to act on your behalf. The problem comes when you have an agent who's acting in their interest. So what kind of situation do we have in corporations? Well, we have stockholders who are the principals, who are the rock stars. They hire agents who are the managers. So in a roundabout way, if I bought stock in Apple, I get a vote on who's going to be on the board of directors. And the board of directors hires the CEO and has a voice in maybe who some of the other top positions are going to be to run the company. I'm on a board of a bank, and we talk about personnel issues sometimes. We try to leave a lot of the hiring, firing to our CEO, but we also deal with issues sometimes within the bank that we have to deal with. And the shareholders, my company or my bank has stock, and we have shareholders that entrust me and my board and the board to be able to make sure the CEO is doing his job right, and we can get voted off if we're not. So we have a conflict of interest, though, between the principal and the agent. So this means that, okay, So as board of directors, I get to determine, we all get a vote on what we get paid. I think it's kind of ridiculous, but we just voted ourselves to get a raise. It's like $200 a month. We got a raise. We all voted on it. Now, you say, well, and it's just like Congress does the same thing. Now, if the shareholders know what we get paid, they can see it in our annual report, and they say, "Wait, you're getting paid way too much," they could vote us out. So our pay, what we get paid to be on the board, we look at, what are industry practices, what are other banks doing, similar size and so on. So we make sure we're not getting anything extra. Okay? So the problem is you have to figure out how, because managers of a corporation, okay. So here's your two blanks. Okay, we have, in a corporation, we have issues between shareholders and managers. Okay? So if I'm a manager and I want my employees to like me, I'm going to maybe give them all raises. Then they give me good evaluations and I get a raise myself. But really, I need to be looking out for what's best for the company. And I got to say, well, should everybody get raised? Should I give everybody 2 months off paid vacation? Well, that's going to hurt the profitability of the company and hurt the shareholders. Okay? But I also want to do what's best for me as a manager. So we have this conflict of sometimes we don't always do what's best for the organization. So let me give you another example. When I travel for the bank, like I've gone to conferences, they pay for my meals. And I just keep my receipts and I turn them in. Now I can get pretty much whatever I want, but I'm not going to go to Ruth Chris and buy the most expensive thing, even though I could. I remember I went to Columbus and I had a meal and I didn't get a dessert because I felt guilty. It's like, well, I shouldn't charge the bank for me getting a dessert. Now, when I go travel for Ohio University, because I've taken students to numerous countries, stayed there for weeks, and the university pays for my meals. So when I go out to eat for the university, sometimes I get really expensive stuff. I'm just kidding. I don't charge the university. No one charges the university. The university has a totally different system. They have what's called a per diem, which in Latin means basically per day. So that means OU says, okay, if I'm in Rome, Italy, this is how much you get. It's a government. The whole United States government is on the same system. Every employee gets the same for breakfast, lunch, and dinner. So if I want to so let's say I get $20 for dinner. I could go to McDonald's, which I've done, and it costs me $5, and then I get to pocket the rest, $15. But if I go out and get a really big steak for $50 and OU only gives me $20, then I end up paying for the rest. And that to me is the fairest way to go about it, because then I don't have to worry about, spending a lot more money. So what is ethical behavior? Last thing, ethical behavior. There's one definition. There are many definitions. This is a cartoon that's kind of demonstrating what I just said my situation is. It says, and it might be kind of hard for you to read here, when using the company's money to pay for a meal, it is expected that you will order the most expensive items on the menu. I'll have the endangered species kebab. Give me the Bigfoot sirloin grilled over moon rocks. So you could do that if that was your business and you had that idea that, hey, this is what we're going to do. I'm going to really charge my company a lot. I know I just lost my video. That's okay. Almost done here. I wouldn't do that. So how do you decide what's the best thing to do? Well, I like this book here by John Maxwell. It says there's no such thing as business ethics. There's only one rule for making decisions. Okay? Only one rule. Does anybody know what that rule is? Well, and I'd write this down. I think I might even ask a question on the quiz about it. It's the golden rule, which says, do unto others as you would have them do unto you. So if it was your business, would you want your employees charging you the most expensive meals? If you have a car for sale, would you tell them about the transmission that's starting to slip? Or would you just let them, buyer beware, let them figure it out themselves? How how would you want to be treated? And a lot of times that clears up a lot of gray area as to what you should do. It's simply how you would want to be treated. And since people are so unethical, the government had to put in this act, Sarbanes-Oxley, often referred to as SOX. If you're accounting majors, you'll see this a lot. And it simply said that corporations must accurately, there's your blank, present their financial statements. And you think, well, of course they would. Well, they need to do it because it's against the law, and there are firms that haven't done it and they've gotten in trouble. And there are a lot longer jail sentences now because of that, and that's been a while ago. But a lot of CEOs used to say, hey, I don't know what's going on with the accounting, so I'm just ignorant of it. Well, now it doesn't matter if you understand them or not, CEOs could potentially go to jail. Okay? And that is the end of chapter. See if I can get this up here. That is the end of chapter 1. Okay, chapter 1b. We will be. I'll have another video, of course, for all of these, and that's it.